New IRS data confirms that 2026 tax rules are officially changing. And for millions of Americans, that could mean lower taxable income, different paycheck withholding, and a different refund next year. This isn't a rumor or a media leak. These numbers come directly from the US government. According to the Internal Revenue Service, the IRS has released its official inflation adjustments for the 2026 tax year in an announcement tied to Revenue Procedure 2025-32, published on IRS.gov. Here's what every American taxpayer should know. First, the standard deduction is going up again in 2026. For the 2026 tax year, the IRS confirms the standard deduction will be $16,100 for single filers, $32,200 for married couples filing jointly, and $24,150 for heads of household. This matters because the standard deduction is the amount of income that is not taxed at all. For example, if you're a single filer earning $60,000 in 2026, the IRS allows you to subtract $16,100 before any federal income tax is calculated. That means only $43,900 is subject to federal income tax. Those numbers are directly from the IRS's official 2026 inflation adjustment release. Second, federal tax brackets are adjusted upward for inflation. The IRS confirmed that the 7 federal tax rates remain the same: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. What changes is how much income falls into each bracket. The income thresholds move higher, so inflation doesn't quietly push Americans into higher tax rates when wages rise. That means more of your income stays taxed at lower rates compared to previous years. According to IRS guidance, this adjustment is specifically designed to prevent what's known as bracket creep, where inflation alone increases your tax bill. Third, many Americans may notice changes in paycheck withholding. Because employers base withholding tables on IRS tax brackets and deductions, updated 2026 figures could slightly increase take-home pay for some workers. Axios reports that these changes are expected to affect paycheck withholding throughout 2026, not just tax refunds later. Now, quick pause. If you find these US tax breakdowns helpful, consider subscribing. This channel focuses on US investing, taxes, crypto, and financial rules that actually affect your money, without hype and without political noise. Subscribing helps you stay ahead of changes before they hit your wallet. Now let's continue. Fourth, the IRS confirmed that more than 60 tax provisions were adjusted for inflation. This includes updates that affect the Earned Income Tax Credit, retirement contribution limits, and several income thresholds tied to family and worker tax benefits. All of this comes directly from the IRS's official 2026 inflation adjustment release on a .gov website. So what does this mean for the average American household? It means higher deductions, better protection against inflation-driven tax increases, and potentially a different refund outcome when you file your 2026 taxes in 2027. It also means tax planning matters more than ever. If your income is close to a bracket threshold, or if you rely on deductions and credits, these changes can directly impact how much you owe or get back. The most important takeaway is this: these numbers are not speculation. They are published by the Internal Revenue Service, confirmed by official IRS documentation, and already baked into the tax system for 2026. If you live and work in the United States, these changes apply to you. And the Americans who understand them early are usually the ones who make better financial decisions. If you want a follow-up video showing real examples, like how a single worker, a married couple, or a small investor could be affected, let me know. And make sure you're subscribed, because 2026 is shaping up to be one of the most important years for taxes, investing, and personal finance in the US.